Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, May 19th, 2026. It's 10:13 a.m. Eastern Time. I'm starting the video, so we're almost 45 minutes into the trading day. And here's what I'm going to cover, and I'll try to keep to it roughly in this order. If and when possible, if I get the time, I'll have to wait a good hour more, but I'll try to run it through. Been doing that lately in some of the videos, doing an AI summary. So if you come back in, if this video is not fresh, in other words, I publish it, I can't get the summary until they generated a transcript. That's what AI needs to summarize it. And YouTube servers take a little while to do that. All right, I'm going to go over the equity markets first. Float a trade idea out there that I'll share my thoughts on it, whether I'm going to personally take it. I want to share it with you in case it plays out. It's the home builders. Again, I'll kind of go over a few of the charts there and let you guys decide what to do. We'll keep an eye on them. MKTX looks like it broke the trend line today. So I want to go over treasuries as well. MKTX is an active trade idea along with TLT. But again, like I said, I'm cheering those. I'm cheering bonds down and crude up. And told you we don't really need those hedges anymore because we have some solid sell signals. We finally got them, so the hedges aren't at this point in time necessary. And in fact, the more that treasuries yields go up, bonds go down, and crude goes up, the better it's going to be for those index shorts and the semis. And we just need the financials to roll over now. I'm going to get to all that in this video. We'll touch on the VIX. Somebody asked about that. Time permitting, couple gold mining stocks and or GDX. So let's just go there, dive into the charts. Well, here we go. T4 is effectively hit. Unless you're brand new to the site, you've heard me say many times over the years, as I covered in that REMX trade today, and it went on to hit the full, the actual support level. But all these targets are actual support levels on short trades, and their price targets on longs are resistance levels. So you want to sell a little bit before. A little bit is going to be relative to the price of the security. In other words, for example, QQQ is a 700-point security. A $7 7-point move is a small fraction. It's 1%. And so you can even go within there, a little tighter. So we've effectively just hit T4 close enough for government work. You can see we're at 696 and change versus a target of 696. And remember, again, this was based on the 5-minute chart for active traders. That's where we shorted right there off the all-time highs. Milk this thing down so far for... what do we get out of that? If you're an active trader, you could certainly cover here. It's certainly support. But as I've said yesterday, and I've been talking about, the fact that we've now gotten here increases the odds of more downside. And again, reaction or not. A reaction meaning counter trend bounce. We could certainly have that. It's about a 3.5% profit right there. You can see on the pop-up box to the left. So let's drill down or drill over to the longer term charts. We also have an active trade, and this is what I call a typical swing trade. This is my go-to favorite swing trading time frame. I do use multiple time frames, and each trade, the price potential and the scope of the move, or the duration, in other words, is typically, again, generally commensurate to the time frame. What that means is a trade based off a 5-minute chart. Those price targets are usually going to be hit in either measured in hours or days. Go to the 60-minute chart. You're talking a typical swing trading time frame, which is usually days, weeks, and at times maybe a couple months. You go to the daily charts, and then you're talking at least generally, again, a few weeks to a few months, right? And then a monthly or weekly time frame, those are swing and trend trades that have holding periods usually measured in months and at times years. Okay, so hopefully that all makes sense. So just keep that in mind. That's why I always kind of make a point. So on the 60-minute chart, we took out the trend lines clearly, and you still have these targets here, which if, and this is a case of if this, then that. I like to use, it's an app you can download on your phone, and it triggers if one thing happens and another thing will then trigger. And so if this, then that means, like I said back here before it happened, if we get down here, it increases the odds because it's clearly taken us down. I said it would take us down below those trend lines, triggering a more significant, more powerful sell signal in the daily time frame. So there's QQQ. We do not have to squint. I covered that the other day. We didn't even have to squint on Friday to see that it broke down. SOX broke down. And as I said, there's just a lot of hot air. So you see, which is normally the case. We'll use SOX, for example, in a matter of 1, 2, 3, and the day is still young here on the fourth trading session, or we can just go the last 1, 2, 3. We're still in today. We've wiped out now. Going back here, you can see where we're at. 1, 2, 3, 4, 5, 6, 7, 8 trading, all 7. And if we, build on the losses, we'll have wiped out 8 trading days, or you can do it in this way as well. That's 8 trading sessions, which is a little over, you got weekends in there is what I'm getting at. And again, it's just the nature of corrections. And that's why you have to, be quick. If you wait, in a bull market, especially a trending market, you can be the worst market timer in the world. You could be the guy or gal that buys every one of these peaks. And it works great because you'll get bailed out in a trend. And that works until it stops working. So, all right, we'll see. Again, it's we still have plenty of meat left on the bone on this trade. We haven't even hit my first price target. Remember, I kept the targets that I gave you on the initial entry right here. We had right here, the whipsaw, the intraday break, followed by the stick save, and it had an alternative or higher probability entry of a daily close, and that's what we had on Friday. So again, whether you took this full, partial, or you passed and you waited to this, they're about roughly the entries are close anyways. And so there's all your targets right there. And again, nothing is sweeter as far as trading goes than to be in a crowded rush for the exits trade. Like when we shorted silver, got in right before the biggest crash in 50 years. You make enough profits in a couple days to literally, you could stop trading that month if you had, or at that point, if you had a decent amount in it. At least accounts. And of course, you're never going to have all your money in any one trade. Don't get me wrong. It's not like you hit one of those and your whole account's good for the year. But, sit back and wait for your next pitch. And, me, it's just like baseball. Nobody bats 1,000. So we had a couple shots along the way. And all we need to do is catch one runner trade. And it will more than pay for any previously shots that we taken that were stopped out on SOX or QQQ. Yeah, sorry I had to pause it there for a phone call. All right, so that's it. Like any trade either works out or not. These are your targets. Again, 60-minute chart, so typical swing trade. So from Friday's breakdown, if that sixth and final target fits, it's going to be about a 29% profit. If you want to just take, if you're a believer, and we may see that, that's what these targets are for. Support levels are levels that I recognize as support. We danced on this S3 for a little bit today. And yesterday, and then took it out. That opens the door, increases the odds. We go down to T1. It doesn't guarantee anything, but just increases the odds. And then that's going to be a pretty good support level. They'll probably step in and buy it. And we'll see if we go from there. Now, I just want to say this, where to? Anytime you hit support and you bounce, well, if you think there's more meat in the trend, meaning, the correction, downtrend, whether it's the end of the run in the semis, only time will tell there. Objective short re-entry points are back on kickbacks to resistance. So support once broken then becomes resistance, right? So that's an R instead of an S. You have a gap right there. That's the next resistance. And if we have some kind of big move up, you could backtest the trend line and go down. I can tell you right now, you will not want to ride out a backtest of the trend line because A, there's no guarantee that you're going to get rejected if you get there. B, there's no way of knowing when you're going to get there, but just looking at the slope of, a pretty good move in semis, which we've had, it's more like this. And I can play around with the charts and just eyeball it. I'd have to extend the trend line, pull this down, and I could do that. But I'm just showing you hypothetically, come in up here, and that would be, you can look up there, that's 8 days, 39 60-minute bars, and that would be all the way till, you know, about the end of May right there. Again, if that was where a back test was in the semis, and it would also be a 22%, almost 23% run. So I was just kind of eyeballing based on this similar slope. So that's that. So, you know, again, there's you have, you know, your entry point's going to be somewhere in here if you took this trade. Your stops be accordingly based on your price target, your entry point, and then I gave you the SOX targets recently because I've had multiple requests on this SOXS, the leverage 3 time, and we're coming up to that first target now, getting very close to that, which again should roughly correlate with well, in this case you can see it's actually, you got a little more downside here to T1. All right, let me move on. XSD is just the other semiconductor ETF. And like I said, check marks across the board there as well. The breakdown of the trend line and then the break of that 527.90 support. So, you know, just these are just, you know, if you're not an active trader and you just wanted a couple targets, 479.15 and 367.30 on that one. All right, going back to QQQ, let's do this. Okay, had to pause the video again. I wanted to reverse my NQs. Meaning cover short, go long. So this is the, so I just showed you we're at that, the 5-minute chart, the final target there. At final targets, you know, again, on the end of the run on the 5, now we'll move out to here. This is a 15. Bingo, hit that 28,630 target. Let me show you on, today is what, May 19th. So on May 14th, these charts always time and date stamped down on the bottom. We were at 29,703. Told you sell signals to come on a break of this small bearish rising wedge right here. Again, 15-minute chart. So more active trader, but less active than the 5. But either way, it's similar targets with arrows going down here. And remember, trend lines, I always say, are dynamic. Price support and resistance levels are static. Dynamic means you're changing every minute, every second of the day, especially every minute, every hour comes in at a higher and higher level. So had a reaction. Every arrow breaks denote price targets, likely reaction points, 28,630, 69, and ultimately or the downtrend line as that arrow stops. And that was then, was that 14th, 5 calendar days ago. Boom. Bingo. So we have the trend line a hair below, but there's that 28,630, 69 level. We just kissed it. And we have positive AK bullish divergence. Now, keep in mind, guys, again, bigger, much powerful, more significant sell signals on the daily charts right now. So I'm not married to a bounce here. In these situations when there's a lot of hot air and a crowded rush for the exits, like we're seeing in semis now, we can go them right on through there. There is a very good chance by the time this video is over, I may be back out of that position. If I can get a, you know, sometimes just a 0.5% bounce. Where to? Like right now I'm eyeing this. See that level right there? Here, I'll put a line for you. If I could get just shy of that, I always sell a little bit below resistance. That would be good for about a 0.5% pop. I can just eyeball it and tell you that's about a 0.5%. That's what I usually like to juice up. And so what I do when I round trip something like that, you know, basically that's +1 to the trade. You know, 0.5% up minus the 0.5% give back in losses. That's 1. And then actually if we recycle in back there, another 0.5% down to where I was. So that's really plus 1.5. And if not, break on through there. You got trend line support, give it a little room. But if the trend line goes and we have a meltdown day, you know, just a big down, 3% down day in the Qs, then that would not surprise me in the least. So, but the fact I just showed you, we've hit some multiple price targets, says, you know, maybe good for a little reflexive bounce here. All right, let's move on to, let's go back to QQQ. And I already went to the daily. Let's go to the weekly here real quick. These are, I've updated the price targets for you on the weekly chart based on current levels. So right now, these are the current. So what I have is a current of 6 total current targets right there. T1, you can see the previous highs. Remember, we had this trading range right here. We broke down. It proved to be a whipsaw. It gave us this short covering rally there. A pullback to that would be the first target. That's also comparable to this 60-minute target on QQQ and NQ, which there's the trading range on 60, and that's my final target zone. So we come back in there. You probably see them step in and buy. Again, I can only tell you right now that's what I think, but when we get there, depending on the charts look, I'll let you know my thoughts. It wouldn't be, nothing surprises me anymore in trading or investing. But my point is, I wouldn't be surprised to see us smash through there if we get all the way down there, and I wouldn't be surprised if we don't even get there. Nothing surprises me. In other words, I know that might sound like, what are you talking about, Randy? But day by day, minute by minute, every day I look at the charts with fresh highs. And right now, I still maintain these targets. I think that's the most probable scenario. And then again, if and when we get down there, and whether we get a bounce or not, I'll be turning my focus to these longer term targets, which I still very much think are in play. P potential means, if and when we get down here, I'll most likely add those as official targets. And there's that same uptrend line off the March 30th lows. You can see we broke on the weekly chart. Now, let me just do something for those of you that have, unless you're brand new to the site, I covered this a couple months ago. One of many, there's a lot of different long-term indicators I use, but one of them that's very simple and pretty reliable is the PPO histogram. That's these green and red, I call them hills down here. And they just indicate when the PPO, which is down below, this indicator down here, when it makes a bullish crossover, meaning the PPO line is the blue line. When it crosses its signal line, the white line, or its 9MEA, that's a bullish crossover. And they tend to define trends. And so when you're in an uptrend, this was a financial crisis. It might not look like much, but a 55% drop in both QQQ and SPY. The top of the market came a few months before the bearish crossover. This one, it came quite a bit after. So there's some variance there. And there was a correction. We had actually just a sideways market for a while. So best to get away from using these type of trend indicators. And it's best using a trending market right there. There was that 38% bear market in 2022. And the crossover came. Again, this is something I've covered recently. Now, I want to just fast forward to where we're at. So the last two, we had a market peaked here. We had a 25% correction. If you want to call it just a correction, if you want to call it a bear market, you can call it what you want. That's semantics. But the drop from high to low was about 25%. And it came right there. And that was, also you could see, again, it's not rocket science. You can see when the momentum is waning. These are momentum indicators, the PPO is. And so when you're going up, but the histogram's sloping down, the PPOs are sloping down, and you look, you finally get that bearish PPO crossover. You don't get them very often on the weekly. Pretty good trend indicators. So I did a couple months ago. We were on watch, waiting for it. I thought that may have marked it. Now it was before we broke down below the trading ranges. But we went on to hit another one of my favorite long-term indicators, this blue dash line, the 20-month exponential moving average. And so that's popped us up here. So I have another purple line. What I'm going over here, guys, is this is a monthly chart. So this is not a whipsaw. It can prove to be a whipsaw, but the month is still, I'm not going to call it young, but there's still plenty of trading days left. Today's May 19th. So should QQQ go considerably low, should QQQ get down to that T5 or T6 on the 60-minute chart I showed you earlier, in other words, back test the top of the trading range, probably going to put this histogram bar back to red. It's going to move this down because this is intra-month right now. So we'll see on the last day of the month where that is. And if so, then that means that's proved to be a whipsaw. It's not that it didn't signal. It did fire a pretty decent trade. Remember, we covered, let's not forget, like I expected and told you I did personally, covered at T2, which was that, the drop and the bottom and the lows. So there was definitely a correction to be traded there, a profitable correction. Um, it just carried higher, and then so far, again, the month is still, um, we're a little more than halfway through. Has a potential if we continue down here to flip that indicator back, or keep it. I'm sorry, keep it red, because all that matters on a monthly chart is how you close the month. So same thing on SPY, the S&P 500. It's got slightly green right now, but again, nothing between today and the and May 30th matters. So that's that. There's our divergent high. We had divergence at the previous high. We've simply extended the negative divergence, and that's one of many things that has me maintaining these longer term, deeper targets. Kind of just an ongoing play from. We've been topping here with the first divergent high, hit a few targets, hit T3 there, bounced, marginal new, and still divergent high on the monthly chart. So, okay, that's hopefully that makes sense to you guys. I don't mean to be all over the place, but these multiple time frames are relevant. Again, as we did in this video, I covered shorts, went long, but yet I'm talking massive drops in the stock market. But I don't care. I'm positioned right now for where I think I'm going to go in the next hour to days, and I'm going to manage those positions accordingly as an active trader. That's what this site's all about: active swing trading, sidestepping the counter trend moves or profiting from them within the larger trend. Okay, I told you I had a lot of other things to cover too, so let's move forward. Home builders. Home builders looking interesting. I'm going to get to Treasury in a second. We just popped. The 30-year did pop, took us out to multi-year highs. I've talked about, I'm sorry, let me correct myself. Yes, multi-year. We had a double top high, but even multi-decade highs. Like I said, interest rates not seen since right before the financial crisis in 2008, and even going back to the dot-com bubble. That's where the 30-year is broken out. 30-year is important. It's more of a psychological thing. The 10-year Treasury is where you track, mortgages and all that. But obviously that's elevated. It's high. It's not too far. It's like it's in a stone's throw, if you will, from also breaking out to multi-year highs. And I think it will. I've been persistent and consistent for years that I think we're in a very early stages of a new secular bull market in interest rates. That means rising rates, but it's a secular trend. The previous secular bear trend started in 1981 when rates peaked and just finished in COVID at the COVID lows. So these are that was almost a half century downtrend of falling rates, and so I'm looking at a trend that's probably going to last a decade or more. And within there's going to be some big pullbacks. Now, where I'm going with that is, and this kind of relates to the home builders here, with Treasuries breaking out. Here's TYX. Let me just show it to you because I talked about it. There's the breakout recently. I've got a little delay here on the chart. When we go back to this weekly chart or even the monthly chart, you can see, as I've covered here, let me go to this board. If I put or I'll just take the line across on the screen again, because there's always new subs coming in. So we had two previous highs here that it just popped above. But here, I'm taking the line across. Right here is 2008. This was the financial crisis. Remember, we're looking at the yield on the 30-year bond. So that takes us back to where rates, my line's not exactly parallel here. Let me try to make it a little more parallel. Come like that. You can see this is where rates bumped up to right before the financial crisis. And this is where the dot-com bubble was right here. It peaked, Nasdaq peaked in March of 2000. And that's rates had kissed that. Actually, we're coming off and a little bit above that level. But again, we were in a secular bear market. Like I said, this takes us back now to rates not seen since then. Now, what I'm going to tell you is I don't have to be an employee of the U.S. Department of Treasury. I can tell you the Treasury Department right now and just about all assets, probably all hands on deck to do something about this. We already heard, I told you just a couple weeks ago, this was, kind of the writing was on the wall. The UK gilt had broken out. Their 10 and I think their 30-year bond, their sovereign, their version of our treasuries, broke out the new multi-decade highs. I think somebody told me the Japanese 10, or they even have, I think, a 40-year bond in Japan now. We used to issue up to 40 or 50, but we only do 30 now here in the U.S. Either way, that's no bueno. There's no positive spin. But what I'm trying to say, it's going to be all hands on deck to bring that down with whatever, they get creative with all these tools. But the problem, again, I've talked about, inflation really handcuffs, and it's not just Treasury. The Fed, I'm sure, also, because their whole little bullshit two-pronged directive is maximum employment and price stability. But yet here we are, we've been at, their, record low unemployment, and we've been running way above their inflation target, yet they've kept the easy money policy. So I call bullshit on them, as everybody does. They've been too easy, and it's the nature of the beast. They just figured, because they got away with it since the financial crisis. Every time the market would hiccup, go to zero rates, pump money, make fake money up. They call it helicopter money, and quantitative easing. Just creating new dollars, and it worked great up until shortly after COVID, when all this all the economics books that said if you print a lot of money and you keep rates artificially low, you're going to get inflation. And they thought they had all this figured out from the financial crisis, and they kept these bouts of quantitative easing going and the zero rate policies. But finally, inflation came home to roost. And now it's an ugly monkey they can't get off their back. And so all I'm trying to say is, when I go back to the home builders, I'm not taking it right now, but I'm passing it along, because if they can come in here and pull some kind of shenanigans out, and I expect nothing less. Again, I think I think the Fed has lost a lot of its effectiveness, and Treasury too. And Treasury's been playing the short game since Yellen. As Treasury was coming due, issuing more and more on the short end of the yield curve, thinking and betting that the rise in the longer term rates, the 10 and the 30-year bonds and out that range, was just a temporary aberration. And you can only do that so long, because when you keep issuing, as treasuries are coming due and you go to pay for this ballooning fiscal deficit that we have, by issuing more T-bills and short-term bonds to pay for the ones coming due, and the current interest rates, which continue to rise, our debt service, the interest we have to pay on the bonds, well, that then creates a problem, a big problem, in my opinion. And don't get me even started on the GSCs and other things like that. There's a lot going on in the bond market. But okay, so let's get back to the home builders. I know I'm kind of all over the place on this one, but this is ITB. There's two home builder ETFs, a lot of XHB, a lot of people talk about, and it also has a similar setup here. Long term, I think it looks like death. A lot of charts look like death to me in the stock market, when I go to the weekly and monthlies. Short term, you have positive divergence. Last time we had it was right here, and the time before that right here. And then we had a divergent low right here. And you can see what happened after each of those. Now, the problem with that is, in a secular bull market, positive divergence on the daily chart usually leads to new highs. What that hasn't happened here since this one. We had a divergent low, we fell shy of the all-time high. We put another divergent low, we've had it about an equal, but we were still lower. So where I'm going with this is, you have to be careful. The things that work so well for so long, in, again, one of the longest bull markets in history due to the excessive easy money policy, if and when we'll talk about the home builders, if they have begun a new longer term bear market. And you can't say that right now, just because they're off the highs. You can't really call it a bear market. This is just a big sloppy sideways range, right? Let's call it that. But again, you have a peak there, you have a lower high so far, there's a low. Now, if we take out that low, and you're going to say, you know what, you have the early makings of what may be a new bear market. And again, you go out to the weekly chart, and you can see it better there. So this is a secular bull market, and only time will tell. So where I was going with this is I'm sharing it as a setup. I'm sharing it because I know there are some that are very bullish on the market, and that's fine, at least a few here on the site. And if you're looking for a sector that stands out, or individual stocks, this one right now, all I can tell you definitively is there's positive divergence. And even in a bear market, that's usually good for bear market rallies, if that's all this is. So that's it. Pass along swing trading ideas. I'm going to go through the components. XHB, ITB has a higher concentration of the actual builders. So I'm going to go through ITB because, number one, it's also at a trend line support right here, the ETF itself. So here's your uptrend line. Comes off the 2022, mid 2022 lows, comes in again the fall of 2022, and we're at that trend line now. So it hasn't even been validated. What I mean by that, in my book, you have to have at least 3 distinct reactions to validate a trend line, because I always say any 2 points could be connected at random. So if we do bounce here, it will help validate that trend line. I can tell you what we do have right now is positive divergence. I also, again, in my book, and I'm being, metaphorically speaking, I don't have a book that I've written, but in my book, I like to see a bullish crossover on the PPO, meaning the PPO turns up, makes a bullish crossover to effectively confirm or put in this lower low, because it's a momentum indicator. Right now, the momentum is clearly down. So, and I had a trend line here. I have it on a lot of the individual stocks. So it's a trade setup. You might want to wait for a buy signal. You have a minor little trend line right here that's going to show better on a 60-minute chart. And then you can come off the high as well, secondary trend line right there. So pops above there, plus a recovery back above the $88. It was support right there that was broken. Should trigger a short covering rally, maybe back to the 200 days, just like we had right here when it got rejected off the 200s. I drill down to the 60-minute chart. You can see that there's that little minor trend line that could bring in the first wave of buyers. There's a secondary trend line. There's your positive, aka bullish divergence. So there's a setup, an ETF, especially for anyone looking for longs. And I'm going to go through not all, but just the top components here to show you, that the charts confirm at least a lot of stocks at support. As I often say, an index or a sector is simply a sum of its parts. So we're looking at, I always have the lists on the components queued up and loaded by order of market cap. Home Depot, I know is not a home builder, but it's in that ETF. It's also in XHB. It's also one of the top holdings there as well. So you have Home Depot, Lowe's, Sherwin-Williams, and then you get in, you can see down here, as far as market cap goes, the builders, D.R. Horton, Pulte, Lennar, and so forth. And then Toll Brothers right there. And then others are Sherwin-Williams obviously goes hand in hand with home building and the housing, as does Home Depot and Lowe's. They both have channels where they distribute to, I believe to supplier builders. But then you also have the remodeling thing. When the housing market's hunky-dory, people are more apt to remodel their house and paint it and, do projects and all that. So Home Depot and Lowe's tend to move along with it. All right, all I can tell you definitively is Home Depot's at support. It's not super duper support. It's really more of a mild support level I've had here for a while. But as I look at it here, there's some reactions there. So again, it's mild support. This is better support. If Home Depot falls down here, I might revisit it. Only problem, it's going to burn through this divergence. It's holding on by the skin of its teeth, some positive, aka bullish divergence. Last divergent low I had on the stock was right here. Then I had one here, 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 and here. You can see what happened each time. Again, divergence isn't a buy signal. What's a buy signal? A break of resistance. So in that case, a couple trend lines here. Popped that trend line. Good for a rally. Got checked at the 200s. a lot of these are, divergent lows, falling wedges. All right, so that's it. And again, usually what you see even in a bear market is they step in and buy these support levels and good for a bounce. So let me go through the rest real quick. There's Lowe's, a big competitor, obviously, to Home Depot. Also, this is better support. LOW is a ticker right here, Lowe's company. Lots of reactions over the last few years, going back to 2024. Positive, aka bullish divergence, and a nice, well-defined downtrend line on that one. So that's a bullish falling wedge pattern. So there's two objective entries. You buy it at support in the same way that I cover short trades just a little bit above the actual support level. This is about 212. It says 211.95. So I'm going to call that 212. Today it hit a low of 213.50. Close. And that might be all it is. Because if a lot of eyes see this, they do what I do. They step in. They don't want to miss the turn. So I'd rather step in a little early if I was short the stock, which I wasn't. But if I was, that's where I would have been covering, right around there. And if I want to buy it long off support, that's what I do. Or means you could take a starter here and then wait for breakout above the wedge. And again, I go over these videos and I go over a lot of stocks because if just Lowe's breaks out, but the rest of them keep going lower, that breakout's going to fail, right? So watch them all, even if you're not going to trade them all. If you want to keep it simple, just use an ETF. You're going to dilute your gains versus picking out the most bullish stocks in the sector and then avoiding the most bearish, but it's a safer way to go. You don't have to worry about navigating earnings, which could really hurt you if they go against you. There's Sherwin-Williams. I'm going to move a little faster. Nice support, 293-ish. I have it at 293.12 right there. And same thing, nice, well-defined downtrend line, bullish falling wedge, positive divergence, just like this was a divergent high at resistance. This is the same exact thing in reverse. It's my, big part of my trading style. Look for stocks rallying into resistance, overbought conditions, negative divergence. You can either short them at resistance, which is objective, and or wait for the breakdown below support. And the same thing here in reverse. DHI, DR Horton, nice support level going back. You can see that reaction there. I'm taking the line across, another reaction. And here's one coming up on support as well. These are trading vehicles. These swings, this thing's just been gyrating like in a regular EKG, but those are 25% rips and dips right there. And so if it has another pop, the market holds up. I just made a case, at least for the short term, to go long in this video with QQQ and NQ hitting my price targets on the 5 and 15-minute charts. There's your, sometimes you get what I call an ADL, almost divergent low. I mean, technically you have to have an equal or lower low as long as the indicators are making higher lows, but again, very close. So minimal downside. And take take a long here with a stop somewhat below. Somewhat, you might want to allow for an intraday or 1 or 2 day pop below there because that would simply extend the divergence and then you could see a recovery. But it also depends on the whole stock market. If the stock market craps out big time, then yeah, it's going to take a lot of these stocks down with it. A lot of the stocks in this sector are also components of the S&P 500 or the mid cap index or the small caps. Pulte, another one. Nice. Look at that. Well-defined downtrend line. Bullish falling wedge, positive divergence at support. Okay. So I can pretty much stop here. I'll click through so you can see others that I like. Lennar, bullish falling wedge at mild support, but strong positive divergence. And again, a nice trend line in which to trigger buy signal. I'm going to move this line up here. That would be my first. And right now, only target. Well, let's say if it pans out, if we break out 97.82, so a little shy of that, and then it'll probably want to come back and check its 200-day moving averages as well, just like it's been doing here lately since it lost them right there. Lost the 200s in a bull trend, bear trend, lost them here, bear trend, you sell them, it got rejected. Finally, it took them out right here after testing them for a while, entered a bull market. It has a history of going a little bit through them on the back test, but then it clearly lost them here. You didn't have to squint to see that. And then it's been in a bear market, and they've been selling rallies back to the 200s. So it's not an unrealistic target to think it could make another run at the 200s, even if it's in a bear market. So again, Bear market rallies are some of my favorite to trade. They're more profitable than buying in a bull market because short covering rallies are powerful. Bear markets in general are just way more profitable to trade as an active trader if you have those skill sets, because stocks tend to fall faster than they rise. They usually wipe out, in this case, in a matter of about 6 months. You wiped out all the gains that it took the stock to build over 1.8 years. So a 3-time factor on the downside there. And that's typical. And you go to the semis and other things when they crash. We saw it in silver recently. What did silver do? It was a great example of something that went parabolic. And so the poor guy or gal that bought right here on silver, and just the initial crash was a 41% drop, and that wiped out. You can see, well, we had gone parabolic, so time-wise it wasn't as severe. That's an example of a parabolic crash, but it still was a lot faster. That happened, by the way, in just 2 days. So yeah, 2 days wiped out, what is that, a couple dozen candles? So several weeks of gains. And I'm just trying to use the example, guys, of why you see so many short trades here, even in bull markets, because they're profitable. But you got to be Johnny on the spot, especially in a bull market. There's an old saying: never ever confuse genius on your part with a bull market. What that means, like I said earlier, traders with the worst timing skills that are buying every high in a bull market, you get bailed out because the trend. So again, that's the saying: don't confuse genius on your part with a bull market. But in a bear market, what happens? Those same dip buyers or bad timers, they buy the dips, but then you just keep going down lower. So as an active trader, you want to be short these drops as we were there, and then long as we were. Told you expected the bounce. Gave you my longer term outlook on silver, which is after the initial crash, and I've showed it to you on the long-term chart. We're not looking at it here. I have a different charting platform with that chart marked up, that you go into a multi-month, and it can be up to a year. It's usually at least several months, if not more, of sideways chop and slop, and then the bear market resumes. That once the parabolic tops in, that's usually it, the end of bull market, begin of bear market. All right. Okay, let's go back to treasuries. Talked a little bit about that. Yes, I think all hands on deck right now at Treasury and the Fed. I'm sure the Fed's worried about this as well. And you can see here, on TLT, we're just below there. And let's see, do we still have our divergence on the 60? By the skin of our teeth, we still have the divergence. So again, you can keep this on as a hedge to index shorts, because if treasuries continue to fall, meaning rates go up, that's going to continue to put pressure on the stock market. So you most likely see your at index and sector shorts like the semis and tech continue to fall. And so you would be losing money on your treasury long, but making money on the index shorts. Again, I told you I don't think you need the protections, as long as those sell signals are on now that we got on Friday. But there it is. And then on that, the MKTX active swing trade, if I can get to that, let's go daily chart, MKTX. I got a price alert on it today. It's trying to pop. It is it is currently right on the trend line. And again, it's just strong positive divergence, been building for a long time on it. And they make their money from bond trading, which typically correlates with treasuries going up. But if there's maybe a breakout in treasuries, the 30-year does run high and the stock market goes up, again, I think you'll see a rotation into treasuries. If nothing else, I suspect, even though I think longer-term treasuries are going to break out of the those multi-year high, and I mean, they already broke out, but marginally, slightly. I'm talking sustained breakout and run. But at this point in time, like I said, if it's kind of the market's pushing on a string here, if treasuries go up much more, stock market's going to drop, and at some point you're going to see rotation from institutions into treasuries as a safe haven. Either way, guys, I trade only on the technicals. This one's still an active trade, and I just want to point out that it will offer an objective add-on or new entry on a solid break above the trend line, especially on a daily close. These are still your price targets, 1, 2, 3 right here, T1, T2, T3, and that's it would be most likely, again, whether treasuries go up or down. This is a standalone trade. It does, as I've covered in the past, have a high correlation to TLT, treasury bonds, and put an overlap there, turn off all the other annotations, and you can see it typically moves up and down as the white line, which is TLT, shows you with treasuries. And so that sometimes you can get a little kind of heads up when this one turns, but there are times where they can go their own direction. So I'm not putting this as it's not a guaranteed positively correlated trade. Sometimes these guys will go the other way or kind of do their own thing, and then, but for the most part, they tend to move together. All right, and again, it's just one of many ideas. Spread your bets. Don't put all your eggs in one basket. But on its own technicals, it still looks good. All right, we are almost done. Yeah, let's wrap it up here. I'll cover the miners in another video. We'll definitely do that, and because that probably warrants its own video. I have to talk about the dollar index, gold, silver, and yeah, that's about it. So let me wrap up here, get this one out to you, and time permitting, I'll try to do an AI summary. So if you're, what is it? It's 11 o'clock now as I'm ending this video. Might take a couple hours depending on what else I have going on today. This has been Randy Finney with the Right Side of the Chart. Have a great day.